Hey, what's up everybody? Ralph here. So today's topic, I want to talk to you guys about why you shouldn't have to worry about the interest rate hikes by the Fed. Now you hear a lot of people talking about, how the Feds are raising the interest rates by, 0.75, by 75 basis points, which is about 0.75%. And a lot of people worried about it because, when they hear that, they think of like mortgages. They say, oh man, the interest rates on mortgages is going to go up. And in a sense, that's true. But I'm here to tell you why you shouldn't have to worry about it, because I think a lot of people don't really understand how it works. Now, when Feds are raising the interest rate, what they're necessarily doing is basically raising the interest rates between what banks lend to each other. So when you hear the Fed's increasing it by 75 basis points, let's say the interest rate is basically like 1%. So that's the interest rate that the banks are able to lend to each other. But what happens is, let's say the banks are lending at 1%. What they do is, if you're trying to get a mortgage, they're gonna give you an interest rate of, say, they'll say that you qualify for an interest rate of, say, like 5%, right? So they're getting interest rate at 1% and they're selling it to you a loan at 5%. They're getting that 4% margin. So basically what it is they're gonna find a way to transfer that cost over to you. So that's what it really means when you hear all these interest rates going up. Now I'm here to tell you why you shouldn't have to worry about that in a sense. On a macro level, you should worry about it because when you hear the Feds raising interest rates, that means they're trying to curb inflation, right? And if they do it too much, this can risk a recession. You'll see companies laying off, as you see now. And in a sense, in a macro level, that does affect affect people personally, because you don't want people getting laid off. But this is what the Feds do in order to curb inflation. But on a micro level, the people that are going to be affected most when it comes to these interest rate hikes are people that are looking to borrow money. Remember, interest rates don't affect you unless you're borrowing money, okay? So if you're someone that's looking for a mortgage, then obviously, banks want to, make their margin, so they're going to charge you a 5% interest rate. So obviously, if you're someone that's looking for a home, it's going to affect you, right? Especially if you're someone that doesn't have a good credit score. But if you're not looking for a home, then you don't have to worry about the interest rate hike, right? Now, I know a lot of people are, trying to look for homes, but the problem is, like, some people will tell you that it's probably not the best time to look for homes. Because like I said, if the Feds are trying to raise the interest rate, it's because they're trying to curb inflation. But what people are seeing is that as the Feds are raising the interest rate, they're also still seeing housing prices still going up. And that's a bad combination, right? Now, it's okay if they raise the interest rate, because if you look at history, mortgage rates were much higher than they were today. At some points they were at 11%, 15%, depending on what time you look at history. So this is not something new. But the thing is, when those interest rates were pretty high, you see housing was much cheaper. It wasn't as high as it was today. I think the average cost for homes in the United States are about like $420,000. So if you have the average home costing $400,000 and the interest rates continue to go up, that's a horrible combination, and that wouldn't be a good time to buy. So what the Feds want to see is that as they increase interest rates, they see housing prices coming back down. We haven't seen that yet, but I think some people think there's some signs of doing that. So if you're looking for a home, then obviously this is going to affect you, right? Another way this affects you, if you're looking to get a car loan, right? Interest rates on car loans are going to go up. So the way to avoid that is don't get a car loan, right? Try to buy your car in cash if you can. Obviously, I know a vehicle, is a big purchase, and obviously used vehicles are going up. But I'm just here trying to tell you how to break it down. That if you really understand, like, when these interest rates, they don't really affect those that aren't looking to borrow money. If you're not someone that's managing your money properly and you're not looking to borrow money, it's not going to affect you. So like I said, if you're looking to buy a car and you're looking to finance it, expect your interest rates to go up, right? Unless you got really great credit. The other thing it affects is student loans, right? Student loans. If you're someone that's trying to get an education or get a loan to go to school, that's going to affect you as well. You're going to see the interest rate goes up. But me personally, if you probably watched any of my videos and you've seen other people talk about it, me personally, I think four-year universities are scams. Most degrees are useless, right? Unless you're trying to be an engineer, doctor, lawyer, or math and science. Like, most of the degrees out there are useless. People are wasting their money. People are spending tens of thousands of dollars to get useless degrees that they're probably not even going to use. And I'm not saying not to get education, or I'm not saying that education is not important, but to go to to rack up tens of thousands of dollars of debt for a four-year university, most of the times it's not worth it. You can just go to a community college and get your education there. There's many ways to get education. There's many ways to be successful without having to go to a four-year university. But just understand that. And you can see the crisis that we have with student loan debt in this country. You know, people trying to get their loans canceled, right? After, you know, choosing to go to school. But my thing is, like, it's only going to affect you if you're going out there trying to get a loan for a school, right? If you want to wait and not worry about get a degree, or rack up $1,000 of debt just to get educated, then these interest rate hikes are not going to affect you. Another way it affects people is through credit cards, right? Now, if you're someone that's managing your money properly, then you're not worried about credit card interest rates. I don't care if the interest rate was 1,000%. Smart people make sure that if you have a credit card, you have a balance, you pay off that balance the following month. I don't like, for me personally, if the interest rate on a credit card was 1,000%, I wouldn't worry about it because I never keep a balance on my credit card. All right, I make sure to pay that balance off every month just to avoid interest rate fees. But if you're someone that's not managing your money properly, interest rate fees on a credit card is going to kill you. All right, they can be anywhere from 15 to 24%, depending on if you miss a payment or depending on your credit. But if you're someone that's managing your money properly, you're paying off your balance every month, then these interest rate hikes are not going to affect you because you're paying that balance off every month and you're not paying any interest rate fees. So these are ways that these interest rate hikes affect people. If you're someone that's borrowing money, then these interest rate effects are going to affect you. But if you're someone that's saying, all right, you know what, these are obviously times are uncertain, I'm going to try to make sure I manage my debt where I don't have high debt, I'm not paying interest on this debt, then it's not going to hurt you as much. Like I said, on a macro level, it's going to hurt people because as the Feds increase interest rates, companies are going to say, all right, I need to make my profit. And right now, the economy's going slow right now, so they're not making as much revenue, so they have to cut somewhere. And usually the highest expense for a company is labor, so they're gonna cut labor. So on a macro level, yes, it's going to affect you, but on a micro level, if you're not borrowing money, it's not going to affect you as much, right? Now, obviously you have inflation where people can feel it, where obviously you're consuming, you're buying things. That's where you're gonna feel it the most. But in terms of interest rate hikes, if you're someone that's not borrowing money, you're not really gonna feel it. And as long as you're managing your money properly, you'll be okay. It's just, you got to make sure you're keeping your expenses low. You're not making unnecessary purchases, and you just make sure you're living within your means in order to get through these tough times. So that's all I got for you guys today. I hope you guys found this information useful. If you got any questions, make sure to leave a comment down below, hit the like button, share, and please do not forget to subscribe, all right? So you guys take care and have a good one. Later.